In this video, I will be talking about accounting for derivatives. Derivative financial instruments are instruments that derive their value from the values of other assets. So up until this point, we've talked about things like stocks, which provide their value by giving ownership of the company, bonds, which provide value by paying interest, and also there are commodities that have value just intrinsically. People are willing to pay money for gold, and so they have a value in possession of those items. However, a derivative financial instrument is just a contract, and its contractual terms depend upon what those stocks, bonds, or commodities do. So, for example, it could be a contract that provides the option to buy a stock at a future date for a set price. So you don't currently own this stock. You don't have to buy any of the stock to engage in this transaction, but you have a contract that says that you have the ability to buy stock at a future date for the contracted price. In this case, the value or option premium of this item is in the fact that you have an option. So as long as there is time left on the contract, there is time for that stock price to move in a direction that is valuable to you. And the stock itself, so where the stock value is in relation to that set price. So rather than the value coming from the stock going up, the value comes from where the stock price moves relative to your contractual price. Some types of derivatives, this is not an all-inclusive list, include forwards and futures, options, and swaps. So a forward or future is a contract that creates an obligation to buy or sell an asset at a future date for a specified price. So let's say that I know that I am going to need wheat in the future, but I'm not ready to buy it right now, or maybe it's not even available right now, but the price is great right now, and I would like to lock it in. And so what I can do is I can enter into a contract that will allow me to buy wheat at the date I need it, because if I buy it now, it's just going to spoil, at the price that I currently like in the market today. A forward is, the difference between a forward and a future is that a forward is private and customizable, whereas a future is standardized and traded on exchanges. An option, on the other hand, is a contract that provides the option to buy or sell an asset at a future date for a specified price. So if I was to enter into a contract that gave me the option to buy wheat at a future date, if I got to that date and it turned out I didn't need wheat, or maybe the price of wheat was now better than what I had contracted earlier, I can just walk away from this transaction and just go buy my wheat in the open market. I am not obligated to act on this contract. And then finally, we have swaps, and swaps are contracts in which two parties exchange cash flows. This is usually, but not always, related to an underlying asset held by each party. A little bit later down the road in this chapter, we're going to talk about interest rate swaps as a very detailed example of this. So why would a company enter into a derivative contract? So the first reason is to make money, duh. So speculators place bets on how the underlying asset prices will change. So derivative contracts at their heart are gambling. You are betting on the market doing something, and you're trying to enter into a contract that will be advantageous to you if that does happen. An alternative that's slightly less risky is arbitrageurs, who will take advantages of market inefficiencies to kind of play both sides of a transaction in two different markets and profit from the difference. So an example here in our kind of a real world example of this, not using these derivative contracts, is thinking about every year at Christmas, how there is always some new game that is the it present that all the parents are trying to go out and get. And so every store has a limited number of these. People are waiting in line trying to get these things. And the manufacturer of that toy will set a price that the store can charge. So even though these people, there's huge demand for this toy and the store could charge more, the manufacturer has said, no, this is the price that you're going to charge. We don't want it to be more than that. So what will happen is these arbitrageurs will go in, will buy the the new hot game at the manufacturer's price. They will then turn around and sell it on eBay for a higher price. not exactly what the manufacturer had in mind. But if the market demand is there, they will be able to make a profit because they're able to charge more than what the original store was able to charge. The really less risky way to use derivatives is they can also be used to hedge risk, so to decrease risk as opposed to just straight gambling. So, ways that you can hedge risk are producers can lock in today's prices and provide the product later. So, let's say you are a farmer and the prices of wheat are great right now, but your wheat's not going to be ready for another 3 months. It's still growing. If you can sell your wheat today and deliver it later, then you can you can get the advantage of the price now, even though you don't have that product. Consumers can buy at today's prices that they know they are comfortable with and avoid future uncertainty. So let's say that I am running a company where I know that I need gas to drive my delivery trucks. And in order to maintain my margins, I can't pay more than X dollars per gallon of gas, or my whole profitability margin goes down the drain. So what I can do is I can buy gas at today's prices, if those work with my profit margins and my business model. And then I can take delivery of that gas at a later date when I need it, but I've locked in today's price so that even if that price goes down, I don't care because I was so worried about it going up, and I'm happy to pay what I'm able to pay. And then finally, to offset the risks from changes in interest rates or foreign exchange rates. So you can think of things here like variable rate mortgages, which caused a lot of trouble in the housing market a few years ago. So variable rate mortgages basically mean that whenever interest rates rise, so does your mortgage payment. And so if you think about, paying your monthly rent, if your landlord were to just arbitrarily decide to increase your rent every so often for, a couple $100 here, a couple $100 there, and it kept going like that, you'd be in trouble really fast, right? And so if you are in a variable interest rate loan, for example, you can enter into a derivative transaction that will help you minimize the damage should interest rates start to go up. So how we account for derivatives is going to depend on how the derivative is being used. So if we are using the derivative for speculation, so just purely an investment interest, an investment vehicle that we are basically gambling with, we're going to record that at fair value, and the changes in that fair value are going to go through net income. However, if we designate this derivative in a hedging relationship, which means that we are using it to hedge some sort of business risk within our company, then accounting rules are going to give us a little bit of a financial reporting benefit so that we can demonstrate that we're not actually engaging in a risky behavior. We are actually managing our operational risk with these transactions. So in a fair value hedge, what we're going to do is we are still going to recognize the derivative at fair value, but we're also going to get the ability to mark our hedged item to fair value. So this is going to look a little bit weird to you. We will go through an in-depth example in a future video. The changes in the fair value for the derivative and the hedge item are both going to be recognized in net income. Then for a cash flow hedge, we are still going to recognize the derivative at fair value. We are not going to do anything with the hedged item because the hedged item might be a future cash flow, and so there's nothing on our balance sheet at the time. And so the hedge accounting benefit that we get here is that we are going to get to take our changes in that fair value of the derivative through other comprehensive income instead of through net income. Hey, Brooklyn. Yeah, that's a great question. So the accounting treatment for the speculative derivatives does sound kind of familiar because it's the exact same thing we did for equity investments that had little to no influence. And it's the same thing that we did for debt investments that were classified as trading. So basically any investment that the FASB thinks we are entering into with the intent of benefiting off of it based on fluctuations in its fair value, they think we should mark that to fair value and that the changes should be recognized in net income. ahead and take a look at how we're going to account for these speculative derivatives. So we're going to record a journal entry whenever a new contract is purchased, whenever we reach a reporting date, because that's going to require a fair value adjustment, and whenever the contract is settled. So let's go ahead and work this example. For this example, we have a call option. So on January 2nd of 2025, Jones Company purchases a call option for $300 on merchant common stock. The call option gives Jones the option to buy 1,000 shares of merchant stock at a strike price of $50 per share. So a little bit of terminology here. The word call option. So a call option is the option to buy, whereas a put option would be the option to sell. The market price of a merchant share is $50 on January 2nd of 2025. Therefore, the intrinsic value is 0. On March 31st of 2025, the market price for the merchant stock is $53 per share, and the time value of the option is $200. So there's a lot of numbers floating around in there. So let's just take a minute to organize the information that we have. So January 2nd is the day that they enter into this contract. The contract is for the option to buy 1,000 shares. And if they buy those shares, the strike price, or the price that's in that contract, is $50 per share. So they would be able to buy for $50 per share. At the time of the contract going into effect, the market price was also $50 per share. And so remember here, this is the option to buy. So if we have the option to buy at 50, what we want for this contract to be valuable is we want the market share to be higher than 50, because that means we can buy at 50 at any point in time and then turn around and sell it to the market for that higher price. So the market price being higher than the strike price is what gives us value. So right now, this market price and the strike price are even. So this contract has no intrinsic value, because instead of exercising our contract, we would just go to the market and buy the shares at $50 per share. However, where it does have value is in the fact that it has a time period during which that market share still has time to move away from our strike price in a way that is favorable to us. So as of the outset of this contract, we believe that that time value is $300 because that's what we are willing to pay for this contract. So our option premium at any point in time is going to be that time value plus the number of shares times the intrinsic value per share. So we're willing to pay for whatever that advantages we have over the market right now at this point in time, plus the fact that it could get better during the remaining time period. So at this point, there is no advantage over the market, so we're just willing to pay for that time value or the fact that this could get better for us. Now, for the purposes of this class, that time value is just going to be a number handed to us. That is a market-driven number, and we are not going to spend any time in this chapter talking about where those come from. Then they give us some information about a future date, which is going to be our first reporting date, March 31st. And so on March 31st, our contract is still for 1,000 shares, and our strike price is still $50 per share. But at this point in time, the market price has moved to $53 per share. And that means that our intrinsic value is now $3 per share, because remember, we have the option to go buy the shares at $50 per share, and then we can turn around and sell them for $53 per share. So we have that intrinsic value of $3 per share in our pocket. But at this point, we are now closer to the end point of our option when we're going to have to make a decision and when we're going to run out of time for this to get more favorable for us. So the time value is only $200 at this point. So again, our option premium is going to be the $200 plus the 1,000 shares times $3 per share. All right. So let's get to the business of our journal entries. So the first one is to prepare the journal entry to record the purchase of the call option. So just like every other investment that we have covered so far, we are going to record what we got versus what we gave up. So we're going to assume that we paid in cash. So we're giving up cash And the amount of cash that we gave up is the $300 that we paid to enter into this contract. Then what we're getting is we are getting an asset. We are getting this call option. And we are going to record that initially at cost. So all of our equity investments, all of our debt investments, and all of our derivative transactions are going to be recorded at cost initially. The next thing we're going to do is prepare the journal entry to recognize the change in the fair value of the call option as of March 31st, 2015. Okay, so remember that we initially purchased our call option at $300, and this is what we have in our asset account right now. But at March 31st, the value of our asset has increased to $3,200. And so this is the balance that we want to have in our call option account at the end of the month. So what we're going to do is we're going to take the difference between these. And so we know we need to increase the balance of our call option by $2,900 to get the ending balance we want, which is that fair value of $3,200. So we're going to debit call option. For $2,900. And this time, we're not paying any more cash. This is just a change in fair value. And so remember, for our speculative derivatives, we're going to treat these just like we did our trading debt securities and our little to no influence equity investments. So this is going to be unrealized holding gain or loss. Then we're going to have a little dash there. And remember, the little dash is really important because it tells the word that comes after it. It's going to tell us whether these changes in fair value are going to impact net income, or if they're going to bypass net income and go sit over in equity for a little bit until such time as we actually exercise this contract. Since this is a speculative derivative, it is going to influence net income every time we make a fair value adjustment. And so the number here is going, or the word here is going to be income. So then the last question here is, what was the effect on net income of entering into the derivative transaction for the period January 2nd to March 31st, 2025? And so they're just asking us to realize that this did have an impact on our net income. That's what that little word income there means. And so we would have an unrealized holding gain because our investment in, or our call option increased in value of $2,900 during the course of the first quarter.